Choosing a business structure can be overwhelming. There are so many options available, each with its own set of rules, regulations, and potential benefits. It's easy to get lost in the details and feel unsure about which path is right for your business. But for small business owners, the S Corporation stands out as a particularly attractive option. It offers a unique blend of advantages that can help you protect your assets and maximize your profits. It combines the liability protection of a corporation, shielding you from personal responsibility for business debts and lawsuits. This separation is crucial for peace of mind, with tax advantages that help you keep more of your earnings. These advantages can significantly impact your bottom line, allowing you to reinvest in your business or take home more profit. The S Corp is popular because it avoids the double taxation that C corporations face, a major benefit for small businesses looking to optimize their tax strategy. Instead, profits are only taxed once, on your personal return, simplifying your tax obligations and reducing your overall tax burden. As a pass-through entity, the S Corp lets profits and losses flow directly to owners, meaning the business itself doesn't pay income tax. This simplifies taxes and saves money, freeing up capital for growth and investment. The reduced complexity can also save you time and resources on tax preparation. Plus, it creates a legal shield, separating your personal assets from your business liabilities, protecting your personal assets from business debts and lawsuits. This protection extends to your home, savings, and other personal belongings, providing a safety net in case of unforeseen circumstances. This means you can take risks and grow your business with greater confidence, knowing that your personal wealth is protected. Without risking your home or savings, it allows you to focus on innovation and expansion without the constant worry of personal financial ruin. The S Corp structure is designed to reward entrepreneurs who create jobs and stimulate the economy, fostering a positive environment for growth and innovation. By aligning your business with these incentives, you can unlock additional benefits and opportunities for growth. You can minimize your tax burden and build sustainable wealth, creating a solid foundation for long-term financial security. For many, the S Corp is the smartest way to balance protection and profit, offering a strategic advantage in today's competitive business landscape. It's a cornerstone strategy for entrepreneurs aiming for growth and long-term success, providing a framework for sustainable profitability and expansion. In 2025 and beyond, as the business world continues to evolve, it remains a top choice for savvy small business owners seeking a structure that supports both their financial well-being and their long-term vision. Diving into the world of S corporations can feel like navigating a maze, but understanding the basics is crucial for savvy entrepreneurs. An S corporation isn't a business you form directly, it's a tax election, a strategic choice you make for an existing business structure. It's a designation that can unlock significant tax advantages, but it's important to understand how it works. You start with an LLC or C corporation, establishing the legal foundation of your business. These are the entities you actually create and register with your state. Think of them as the building blocks upon which you'll later apply the S Corp tax treatment. Then, and only then, file IRS Form 2553 to be taxed as an S Corp. This form is your official request to the IRS, signaling your intention to have your business taxed under the S Corp rules. It's a critical step that must be completed correctly and on time. This move lets you tap into special tax rules designed specifically for small businesses, offering a unique opportunity to minimize your tax burden. It's a strategic decision that can significantly impact your bottom line. S Corp themselves don't pay federal income tax at the corporate level. This is one of the primary benefits of this structure. Instead, profits and losses pass through directly to the shareholders' personal tax returns. This avoids the double taxation that C corporations often face. Each owner reports their share of income or loss on their own individual taxes, using a Schedule K-1, which details their portion of the company's financial activity. To qualify for S Corp status, you need to adhere to certain restrictions, including having 100 or fewer shareholders. This limitation ensures that the structure remains focused on smaller enterprises. Furthermore, all shareholders must be individuals or certain qualifying trusts, and the corporation can only have one class of stock. This simplifies the ownership structure and prevents complex equity arrangements. These rules are in place to ensure that the benefits are focused on small, domestically owned businesses, supporting local economies and entrepreneurship within the United States. As an S Corp owner, you're not just an investor, you're also an employee of the company. This means you wear two hats, fulfilling both operational and ownership responsibilities. This dual role is absolutely key to understanding the tax advantages of an S Corp. You earn a salary for the work you perform within the business and take distributions as an investor, representing your share of the company's profits. The distinction between your salary and your distributions is the very foundation of S Corp tax savings, allowing you to strategically minimize self-employment taxes. By understanding and carefully navigating these rules, you can unlock powerful strategies to significantly reduce your overall tax bill, freeing up capital for reinvestment and growth. Making the S Corp election is a proactive and strategic step towards smarter business management, empowering you to optimize your tax position and build a more financially sound enterprise. The S Corp's biggest tax advantage, and one of the primary reasons businesses choose this structure, is how it handles self-employment taxes, offering a significant opportunity to reduce your overall tax burden. Sole proprietors, on the other hand, pay self-employment tax, a hefty 15.3%, on every single dollar of profit their business generates. This can quickly eat into your earnings. With an S Corp, you have the ability to pay yourself a reasonable salary, commensurate with the work you perform for the company. This salary is then subject to standard payroll taxes, just like any other employee. But the remaining profits left after your salary has been paid can be taken as distributions to you as a shareholder, and these distributions aren't subject to that 15.3% self-employment tax, providing a substantial tax advantage. For example, let's say your business earns a total of $150,000 in revenue, and you determine that a reasonable salary for your role in the company is $60,000. In that case, only that $60,000 salary is subject to Social Security and Medicare taxes. The remaining $90,000 can then be distributed to you as a shareholder of the S Corp, potentially saving you thousands of dollars in taxes each and every year. This isn't some kind of shady loophole. It's a completely legal and sustainable tax strategy that's explicitly built into the tax code itself. By strategically splitting your income between a reasonable salary and shareholder distributions, you're able to keep a significantly larger portion of what you rightfully earn. The key to making this work is paying yourself a fair and defensible wage and meticulously documenting how you arrived at that figure. Implementing this approach consistently can result in business owners saving a significant amount of money on their taxes year after year. Ultimately, it's about understanding and working the tax code to your advantage, rather than trying to fight against it. The S Corp structure, when used correctly, effectively transforms the tax law into a powerful tool for building long-term wealth. And that's precisely why so many savvy entrepreneurs are increasingly choosing the S Corp as their preferred business structure. The IRS requires S Corp owners to pay themselves a reasonable salary. You can't just take all profits as distributions. Your salary must reflect what you'd pay someone else for your role. Research market rates for your job, document your findings, and set your salary accordingly. Consider your duties and experience and your company's financial health. A common guideline is a 50/50ths or 60/40ths split between salary and distributions, but your research should drive your decision. Document everything. This is your best defense if the IRS ever asks. Pay yourself through a formal payroll system, not just by writing checks. A well-documented, reasonable salary is the foundation of your S Corp tax strategy. Once you're paying yourself a reasonable salary, you can take distributions, your reward for owning the business. Distributions are simple to process but must be clearly documented in your accounting records. Only take distributions if your business has enough basis, your investment plus retained profits. Exceeding your basis can trigger capital gains taxes. Don't take distributions before paying your salary or in place of regular payroll. Set up consistent payroll for your salary, then take distributions quarterly or annually as profits allow. This disciplined approach keeps you compliant and audit-proof. Proper documentation and timing are essential for protecting your tax benefits. Distributions, when handled right, are a powerful tool for building wealth. Let's compare two business owners, Sarah, a sole proprietor, and Mark, an S Corp owner. Both earn $120,000 in profit. Sarah pays self-employment tax on the full amount, over $18,000. Mark pays himself a $70,000 salary, taxed for Social Security and Medicare, and takes the remaining $50,000 as a distribution, which isn't subject to self-employment tax. Mark's self-employment tax bill is about $10,700. Saving him over $7,600 compared to Sarah. Both still pay income tax on their total earnings, but Mark keeps more of his money. This extra cash can be used for investments, savings, or business growth. The S Corp structure doesn't increase your income, it helps you keep more of it. Smart structuring makes a real difference in your bottom line. This example shows the practical, everyday value of the S Corp strategy. It's about being tax smart, not just working harder. S Corp offer big benefits, but mistakes can be costly. The biggest red flag is paying yourself too little, or no salary while taking large distributions. The IRS can reclassify distributions as wages, leading to back taxes and penalties. Keep business and personal finances separate. Use dedicated accounts and never mix funds. Run a formal payroll, not just handwritten checks, to ensure taxes are withheld and reported properly. Track your stock basis carefully. Taking distributions beyond your basis can trigger capital gains taxes. If you don't have basis, you can't deduct business losses. Sloppy bookkeeping or ignoring payroll rules can jeopardize your tax savings and liability protection. Stay compliant by maintaining clear records and following the rules. Avoid these pitfalls to keep your S Corp benefits intact. S Corp offer more than just payroll tax savings. You can set up a solo 401k, contributing as both employee and employer for major retirement savings. Health insurance premiums for owners can be paid by the company and deducted on your personal return. S Corp can also offer health savings accounts and accountable plans for tax-free reimbursements of business expenses. These benefits lower your taxable income and boost your financial security. The S Corp structure can also help you qualify for the Qualified Business Income Deduction, up to 20% off your business income. Paying yourself a reasonable salary helps maximize this deduction. These extra perks make the S Corp even more valuable for small business owners. With the right planning, you can stack multiple tax advantages. The S Corp is a flexible tool for building wealth and reducing taxes. The S Corp is a powerful tool for small business owners to build wealth and cut taxes. The key is separating your role as employee and owner, paying a reasonable salary and taking distributions. Elect S Corp status, research and document your salary, and use a formal payroll system. Keep business and personal finances separate, and track your basis to avoid tax surprises. Consistent, clear bookkeeping protects your tax benefits and legal shield. The S Corp strategy is about more than tax savings, it's a mindset shift. See the tax code as a roadmap, not a roadblock. By following the rules, you unlock significant financial benefits. From payroll savings to retirement and health deductions, the S Corp can accelerate your path to financial freedom. Manage it right and you'll keep more of what you earn, year after year.